Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into Phil's Tax Hacks and Other Retirement Facts with Phil Putney and myself here to talk investing, finance, retirement. Once again, and this time, Phil, we got to talk a little bit about the loss of a spouse. No fun, dark conversation, but finances.
But when it's necessary.
When it's necessary, life's going to happen.
Yeah.
So let's talk a few strategies and maybe some mistakes to try to avoid ahead of time, because obviously we're not going to be in the right mental state when dealing with things when this happens, even if you see it coming, even if it's a prolonged illness or something like that. So I want to just kind of get into this, and really we talked about doing something different this week, but we decided to come back around to it because it's the nature of what you do, unfortunately. I know we try to have some fun and enlighten people on the show and things. And ultimately what you do is very, very serious stuff. You're dealing with people's life's money, their retirement money, their forever money. But at the end of the day, unfortunately, we all leave, right? And so
it's to your point, not a fun discussion by any means. But I mean, it's a discussion, frankly, we have with every client. It's part of our planning process. The old adage, plan for the best, prepare for the worst, right? So we're planning as though everyone's going to live to full life expectancies. There's no need for long-term care. Does it work?
Right.
And then what if? What happens if? And we always run scenarios if either of the spouses passes early today, when we start the planning process, and then we look at it kind of in 5-year increments to see what does that look like. If either spouse passes prematurely, how does that affect then that surviving spouse?
Well, let's break that down a little bit. We'll try to stay away from the emotional stuff as much as we can. Obviously, it's virtually impossible in this situation, but let's kind of focus on some of the places where folks can kind of make it more compounded, I suppose, adding to the stress of the situation. So we'll just start with the two big ticket items that people are going to hit when this happens to them. So what are those two main things that are going to happen when you, obviously from a financial standpoint, when you lose your spouse?
Sure. Well, I mean, the first is a loss of income. Even if all you had was Social Security, there is going to be a loss of one of the Social Security benefits. So
income
survivor benefits kick in. So all that means is that the surviving spouse effectively retains the highest of the two benefits. So their own or their deceased spouse, if theirs was higher. But to that point, the lowest benefit stops. So from a household standpoint, if you were planning on, based on your housing expense and everything else, this double Social Security benefit, at the passing of one spouse, the lowest benefit stops. So there's going to naturally be, from just Social Security, that. I mean, the other thing would be a pension. If you are one of the fortunate individuals that still has a pension, maybe it was grandfathered, in and kind of frozen, but you've now had that pension into retirement. What was the election that was made on that pension? Is there a survivor benefit? Did the spouse that pass take the single life benefit, right? It's tempting. It's the highest of the benefits. You're thinking, oh, maybe we'll just take that because, statistically they're going to live longer, which great. Understand the math. You're going to run it out to see what that looks like. But if there was the pension, chances are there's going to be some kind of a loss of income from the survivor benefits. Because unlike Social Security, it's not 100% by nature. You have to make the election is what it is, kind of averages that 65% survivor option. Most pension plans have that as a default. If you don't elect anything, that's what they put you into.
So the income gap clearly is the big one, right? That's the first one. What's the second one?
There is going to be a loss of income for sure.
Yeah.
And the second one is what we call the widow's penalty, which is just the effect of going from married filing joint to now being single.
And that's the one, Phil, that catches people off guard, right? Because especially if you had the great fortune of being married a long time, if you're married 30, 40 years or more, and you're used to it. Yeah. And now all of a sudden you get bumped into that higher single filer.
Well, and the reality is what happens is the brackets for a single are the same from a percentage standpoint as a married, right? Same tax brackets percentage wise, but the brackets are smaller. And right now it's basically half.
The money brackets.
The money brackets, right. So to enter the 12%, or exit the 12% bracket, it's around, call it 80,000 for a married couple. For single, it's half that. So for a single, very often we see a surviving spouse with less income gets pushed into a higher bracket.
And it's what right now it's currently what 12 to 22, the next jump.
Right, 12 to 22, right? Yep.
Yeah. So that's substantial.
Well, it's a pretty significant jump, right?
Yeah.
So again, just understand what this looks like. It's, like many things that we've talked about in the planning process is, what does this look like if this happens? And then how do we best prepare for that just in case?
Okay. So let's talk about a couple of things. Let's solve for the income gap first, right?
Yep.
So let's go with that piece. Some things to look at for doing that. So obviously we touched on Social Security. You touched on possible with the pension thing. What are some other things that, obviously the first thing comes to mind is, well, that's what we saved in our 401k or whatever for, right?
Right.
So how do we go about fixing the shortfall?
Well, first is just understanding what this looks like if it happens. And that should be part of the decision when you look at Social Security. So when you're running that math on Social Security, one of the benefits to typically that higher earning spouse delaying maybe all the way to 70 is the survivor benefit.
So you're staggering the two working couples.
Right. Look at what that looks like. Maybe it makes sense for that higher earning spouse to wait till 70 so they can grow one of the benefits so that whoever the surviving spouse is has this higher benefit to help minimize that income gap.
Okay.
I mean, the other thing is when you're looking at the pension, does it make sense to take a lower survivor benefit even though you get the higher number today? Maybe you need to take the lower number to get a higher survivor benefit just to hedge against it.
Right.
Or maybe you do take the higher number, but then use that difference to buy life insurance. And that's kind of the other avenue to help fill the gap is purchasing life insurance so that when one of the spouse passes, then there is this death benefit that can come in, be invested to help make up that income loss.
And a lot of times we think about life insurance as the kind of go-to, especially when we're in our 30s or 40s and we still got our younger kids at home and, yada, yada. But it could still be the same kind of strategy for seniors or retirees as well.
Oh, absolutely. I mean, common misconception is that, well, I'm in retirement. I don't need life insurance. Kids are all graduated from college. I'm retired, so it's not like we're trying to replace my salary. Well, you're right. You don't have those two common scenarios that you would buy life insurance for, but that's the point of running a scenario to say, okay, what does it look like for your surviving spouse if you were to pass today?
Yeah, for sure.
Are they going to have an income gap? For sure from Social Security alone, but how much of a gap is there? Now they're going to be in a higher bracket. How do we help hedge against that? Because now their expenses are higher because of that higher tax cost.
Okay. And then some other strategies, obviously another one that's obviously very popular that people, will just drop the A word, right? Which is annuities. Some people go, they love them, they hate them, they don't want to talk about them. They're the greatest thing since sliced bread. Whatever kind of place you find yourself in, it's still something to at least talk with your professional about. Is it a strategy that makes sense? Right.
If you have an income stream, a guaranteed lifetime income annuity, that has a survivor benefit, and that's the catch, because you can have the one spouse could have taken their IRA, put it into an income annuity for their life, but if they didn't elect a survivor option, well, it leaves the surviving spouse in a very similar scenario.
Yeah.
So again, an annuity, it's another stream of income that if was elected and there was the right survivor benefit up front, it could make sense. At the end of the day, it really just comes down to understanding what this looks like.
But putting a plan in place ahead of time while you're both still here is the important part, so that when the inevitable happens, right, you're easily just, you're no longer here, let's just say, because typically the numbers are what they are. Typically us guys pass away first, then our spouse, our loved one is able to go to the advisor and go, great, here's all the pieces, here's the things that we've got. I'm good, or whatever the case is, I'm going to be okay. That stress comes off the table from that aspect so that you can, rightfully mourn. I think I might have shared on here before. I can't remember, but the lady my wife and I bought this house from, she lost her husband unexpectedly and they didn't have a plan. And one of the things that stuck with me when she told me that was that she told me some of the things as we were breaking stuff down for the house and she was around and she was very, very cool and very helpful, was that she spent 3 years getting everything in order, cleaning up the house, financially getting things in order, getting the actual environment cleaned up, and never got a chance to mourn her husband. So she went right from the loss to right into fix it mode, I guess.
Fix up, yep.
And never really got to properly mourn the man. So that kind of stuck with me, right?
Right. Well, and that's the importance of looking at this ahead of time. At least there's a plan. You're not making decisions in a very emotional state, which The more we can do to help have a plan in place so that you know that when or if that happens,
Yeah.
you're okay. You can mourn your loss of your loved one, do what you need to do and kind of get things positioned right, knowing that the assets are there, my plan's in place, it's going to work. So,
And not making those rush, snap, or scary decisions when you're not in the right
you're not in the right
mind
frame
space.
of mind at that point.
Okay, so let's assume that we've taken care of the spouse. We've got the plan taken care of. So let's look at the next steps here. We want to focus on, as we're getting the planning strategy put in place, what do we want to do for the kids or the grandkids? So I only have the one daughter, so it's going to be pretty easy to kind of decide what happens with our stuff, but everybody's situation is a little different. What are some common mistakes that people step into here?
Well, I mean, when there's a passing of one of the spouses, it's time to revisit all the different beneficiary designations and that estate plan.
Okay.
What does that look like? Because now it's not a surviving spouse that things would go to. It's to the kids. And do you want, depending on ages and, their financial wherewithal, do you want them inheriting a large sum of money at that point? Right. I mean, it's something to revisit again.
Yeah. Last week on the show, we talked about RMDs, Phil. And this changes here as well. So they've changed the rules there, right? If you're leaving your children, let's say, let's just say there's only one of you left, right? And now you're passing, and you're not leaving it to your spouse, you're leaving it to a child, your kid. They've changed the rules on that, on how they get this inheritance. From an IRA standpoint.
I mean, they have 10 years basically to take the money out, so they can no longer stretch it out over their lifetime.
Yeah.
So the tax side of the equation is a big piece of this. And, we were talking about the surviving spouse and having a higher tax bracket. Mm-hmm. I mean, that's something to understand too. And frankly, part of the process we look at in doing Roth conversions, because if we can have money converted into a Roth IRA before that spouse passes, again, remember the brackets are wider, so we can convert more at a lower bracket so that when or if that happens, that surviving spouse doesn't have this big tax burden. Because if it's in a Roth IRA, Roth distributions are tax-free. So it's outside the equation. You don't have to worry about it. Same thing goes then for the kids, right? If you both have now passed and there's money in a Roth IRA, granted, they still have to take it over 10 years, but it's not taxable. So it doesn't pass this huge tax burden onto them.
You're being tax efficient for them. So clearly that's the main one most of us think about. And I think the other one that gets lost in it sometimes is just the communication of your desires and wishes, because a lot of people will just go down the will route, right? So it's like, well, just remember that you will go through probate if it's just a will. And if you don't want that, then it may be worth talking about something like a trust. And I know that people kind of go back and forth on that. As a CPA and a personal financial specialist, Phil, what's your take on that from I guess the estate planning side of things? Because it's not just for the uber rich. We've talked about that many times here on the show. It can be a valuable tool for people, but you need to find out at least.
Yeah, I mean, a trust really comes down to control is what it is. I mean, if you want to maintain control of an asset after you passed, because you have concerns, for the ability of your kids to manage finances, or, whatever it is, their age,
or maybe it's just privacy,
or if it goes to grandkids, or privacy, that's another concern. But trust, again, I think are one of those things that frankly are probably oversold.
Okay.
If you're not concerned with when the kids get the money or the grandkids get the money, you don't need a trust for IRAs, 401ks, those type of accounts, annuities, life insurance, all your beneficiary designations govern. And actually, kind of in the order of things, that happens first. It doesn't matter. So you can have a trust that says the IRA goes to the kids, but unless that beneficiary designation says that, doesn't matter.
So it trumps the will, but it trumps the trust too.
Right.
Okay.
So the only way that a trust doesn't even come into play unless it's named. So the only way for that IRA to go through the trust is you have to name the trust as beneficiary. Then the trust now governs how that asset gets distributed. And that's often people go through all this process and setting up a trust and doing this and then never fund it. Nothing ends up there. So it's an empty shell with a bunch of rules that means nothing.
Wow. Okay, great point. Great tip.
And they think, I set the trust up, I'm good. And they're really not, because they haven't taken that final step to get it there.
That's a great point, right? So, and that's what we try to hopefully share on the show is the little things that we hear or we see as laypersons, right? We don't really truly understand them. So to your point, okay, this guy, I got set up with this guy. He's got me a trust, or the gal, whatever. They've got me into a trust. we're golden, and maybe they've missed that crucial piece. So great point.
Yeah. So understand why you have the trust, right? In today's day and age, I mean, through beneficiary designations, transfer on death or TOD, you can have on non-retirement type accounts, which basically puts a beneficiary designation on that. Most bank accounts, you can even do that today. And then at least in Michigan, you'd have to check in your state if you're out of Michigan. But for real estate, we can use what's called a ladybird deed.
Okay.
Which effectively puts a beneficiary on real estate. So those are kind of the big three items that people are generally worried about. You can keep all of those outside of probate. They never enter that probate step because the beneficiary designation trumps and kicks in. So again, just understand why you have it, right? And does it really make sense? The other side of a trust that is often overlooked, even by the attorneys, because they don't understand the tax side of it, is taxes. So taxes for a trust, I mean, it's a separate taxable entity. Once you've passed, that trust pays tax. The downside of a trust is that it reaches the 37% bracket, the top marginal bracket, at $15,000 of income.
Oh, wow.
So a married couple, you're talking about $500,000 before you get there, right? Trust, no, 15 grand. So be very, very careful from a tax standpoint, what ends up in the trust. And if it gets retained by the trust and it's income, you could end up paying a third or more of it to the government in taxes because it wasn't designed the right way from a tax standpoint. So just understand how it works. You know,
great.
And if you've passed, that trust is in place, the assets are there, it's too late. Kids are stuck with the way it's set up.
So. Wow. Yep. Again, so lots of, things to consider when we're talking about, obviously we're all going to leave here, right? The mortality rate is what it is. None of us, is sometimes, many of us would love to stay around forever, and many of us have no interest in staying around forever, but it doesn't make a difference. We're all checking out at some point of the hotel, right? So you got to make sure that you're having some stuff in place because you do want to make it easier on those that you leave behind. So, whether you're solving for the income gap for your spouse, or you're dealing with the tax situation for your spouse or your children, leaving money behind, using annuities, talking about life insurance, whatever the case is, you got to have a strategy in place. And that's really what, the whole conversation is about. And to, having these things and breaking these things down with Phil is obviously a great way to talk about this because there's little nuggets in there, like you shared this week on the show, that most of us just wouldn't know.
Yeah, have a plan in place. I mean, it's not a fun discussion to have, like many of them. But
right.
I mean, at the end of the day, it's vital to have it at least. Look at it, understand what the potential is, make informed decisions at that point before you're in that emotional state and get forced into some of these decisions, which you might have then lost a lot of options at that stage. So
yeah, I know you've lost a number of clients this year. It is unfortunately, part of the it's part of life, part of life, part of the business that you're in. But if you've got questions, folks, you need some help, definitely reach out to a qualified professional. We always talk about the fact of having a financial team. Certainly in this aspect, you're going to need someone. Phil's a CPA as well as a personal financial specialist, but you're also going to want to have a state attorney, or sometimes I guess it's elder law attorney.
Law attorney,
yeah. You're going to.
Yeah, I mean, if you're looking
in.
more of the long-term care side, things like that, then it might make sense to try to do some manipulations and moving around, trying to get on Medicaid. But
well, you kind of need a little team, if you will, right? Just a little team to kind of help with some of these things in life. And if you need some help, I know, Phil, you probably certainly have people that you refer folks out to talk to from that standpoint, from the legal side, if they need some things. Since you wear a lot of hats, but attorney's not one of them.
No, attorney's not one of them. I don't want to wear that hat.
There you go.
Got enough to wear.
That's right. Well, again, if you need some help, folks, reach out to Phil or whomever, right? But talk to somebody about it. Get a strategy in place. Don't want to be in a situation like I described earlier about with my neighbor, where you can't take the time to really mourn properly and just kind of grieve and do the things that we need to do from an emotional standpoint.
Right.
If we're so busy running around fixing all the X's and O's that we could have and should have taken care of prior to losing a loved one. So that's going to do it this week. Subscribe to the podcast, Apple, Google, Spotify, YouTube, whatever platform you like to use. You can find all of it at philstaxhacks.com. That's philstaxhacks.com. And of course, that'll redirect you back to his main website if you'd like to get some time onto his calendar, or just call him at 248-888-7530. Numbers on the screen for those watching. Or again, or pick up the phone and call 248-888-7530. For Phil, I'm Mark. We'll see you next time here on the podcast. This has been Phil's Tax Hacks and Other Retirement Facts.
Phil? Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.